저는 잘 안 되지만 영어로 발표하겠습니다. 이게 우리말로 하려면 더 힘들어서. This is finance paper, and I'm studying the hedge fund application for the volatility feedback model. So the process is the sequence is I'll explain the moderated factor model first, and then statistical inference, and application will be explained in briefly, and then I'll also do the robustness check in shortly. Farmer is a Nobel laureate, and he mentioned about the stock selection skills of a hedge fund manager and the timing skills. And stock selection skills, the manager is picking the right stock based upon his fundamental research, and then the timing skills basically he is predicting some event ahead of time. So he will looking at the macro or the fundamental event ahead of others, so that he might be able to change his positions before some other people do. So then he might be able to make some profit out of that. Okay. This is a moderation model, and then I applied it to the time series analysis as it is. Okay, so this is in here the y is the return of a hedge fund, and then you can see that y is a t means contemporaneous return, and all other input variables are the 1 month prior. That means you have a system of adaptive system, which means you have a previous month's information of 2 variables, and then you apply to the next month's return expectation. Okay, so I designed it this way because it will be much more practical. Okay, if I put every variable as a contemporaneous, and then it might be able to explain much more. Okay, we have a much more explanation power. On the other hand, which is not really practical, you cannot really use that because you won't be able to know the contemporaneous information at this time. Okay. So model is when you're predicting this month is the hedge fund return, and you get the PTFSIR is a option based the trading strategy, which is following the trend following, and then previous month's trend following strategy and short-term interest rate will be used to estimate that this month's return of a hedge fund. However, that prediction will be controlled by the volatilities of implied equity market, the volatilities. Okay, so this is scared variable. So scared variable will be moderating in a linear fashion. This is a base model, and as you can see, the R-square variable is pretty low, and the intercept is pretty high. That means the model is pretty much misspecified. Okay, and this is the equation 2 is our moderation model, and then you might be able to find it. I showed the base model and moderation model, and then we have the improvement in R-square and then decreasing in intercept. That means the model has been improved in terms of fitting and focusing. And this study is actually started from the base question that the EM means emerging market, LS means long short, FOF means fund of funds, and the GM means global macro, and the MS means multi-strategies, CTA means commodity trading advisors. All different kinds of investment style and the management style. Whether these different type of style managers will show different type of moderation behavior. Okay, that was a fundamental question. And this is my structural model. So the gamma t minus 1 is a moderation effect. So any previous periods moderation effect will be reflected to this month's the market exposure of the manager. Okay, and then equation 6 is the market responsive manager. Equation 7 is usual structural model. And I applied it to the emerging market index, and then here it shows equation 6 has a low explanation power. However, in terms of the systematic factor specification, there is no consistency between two models. That means equation 6 has even though equation 7 has big differences in terms of explanation power. However, equation 6 can be useful in terms of applying behavior issues of the hedge fund managers in a way. And for the robustness check, I applied it to the 3 different types of investment vehicles, and the same base model has been applied to that, and then which shows a very low R scale, very high intercept. That means the model has been significantly misspecified. However, if I put the interaction term as in terms of a moderation equation, then the model fitting becomes suddenly more useful, especially for the diversified number 3. Okay, so. And this is the same diagram. The perception of investment managers' previous month's volatility of equity market will be applicable to moderation effect, and then the red dot shows the third manager MP3. Okay, so they showed a pretty positive the conditional moderation effect. And this is application to my equation model, the structural equation, and in terms of explanation power, there's not much differences. However, in terms of parsimonious, the application, the model 6 works pretty well. The equation 6 works pretty well. Okay, and then equation 6 and equation 7 can be compared in terms of consistency of those systematic factor exposures, and then whenever the equation 6 shows equation 6 and equation 7 shows inconsistencies in the factor exposures, that means there might be some over specification issues. Okay. So this is conclusion. When we're looking at the model in terms of the multi-factor based and controlled, and we can look at it as a usual structural model. However, when you're looking at the conditional moderation effect, and then the model fitting will be suddenly increased, and then it will be much more effective in terms of explaining the behavior activities, actual activities of investment managers. Okay, so this might be pretty much my first application to the Financial Times series of this model, and hope that it might be working to my future works as well.
감사합니다. 혹시 질문 있으신지?